Hey everybody, we are wrapping up earnings season. I am just getting back into action after a pretty hectic summer. A lot of travel, a lot of other stuff going on. So I'm really getting back into the swing here, and we're going to recap some earnings. And one I really wanted to start with is Upstart, ticker symbol UPST, and we're going to dive right into it. So the stock looked really, the numbers looked really impressive on the surface. The stock took a dive. We're going to figure out what's going on. Before we dive in, please check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It is the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel, and I will put the link in the chat or under the description of this video. So let's dive right in. I'm going to share my screen. And like I said, the numbers all looked really solid at first glance. So loan originations were up 154% year over year in what's honestly a not great environment for lending. Interest rates are still high. A lot of people don't want to borrow money. Revenue more than doubled year over year. That the third box right there, net income, that was not supposed to happen. That was a surprise. Upstart's guidance called for a $10 million loss. They posted GAAP net income for the first time since I think 2021. They posted a great adjusted EBITDA margin, 21% margin. So the business on the surface looks like it's firing on all cylinders. And most of the data or most of the other metrics support that. You can see that surprise when I said it was a surprise net income. Look at these losses they were running a year ago. Negative $65 million in the first quarter of 2024, negative $54 million in the second, and then got kind of back to almost break even, and finally they reached profitability. Not a great margin, but it's a profitable company now, and it hasn't been for a while. That's really impressive, considering the current lending environment. On an adjusted EBITDA basis, you can see they were not even profitable on an adjusted EBITDA basis a year ago. Now they are. 21% adjusted EBITDA margin is pretty fantastic. So they also raised their guidance. So that's kind of the trifecta. They beat expectations on the top line in terms of revenue, sales growth. On the bottom line, they beat expectations by reporting a profit where they were not expected to. They also raised their guidance. They're now calling for positive net income. It was $6 million in the second quarter. They're calling for $9 million now in the third quarter. They're calling for $35 million of net income for the full year, which means they think they're going to have an excellent fourth quarter, which there is some seasonality that's going to help that. They're calling for $1.055 billion in total revenue this year. That would be their first year above $1 billion ever. Even in like the 2021, free money era, they didn't hit $1 billion in any given calendar year. So really impressive, guidance here. Net interest income is a big part of that. They wouldn't hit $1 billion without that. Upstart has some loans on its balance sheet, which we'll discuss in a minute. They also have some cash that generates interest from and things like that. So, the high interest environment it hurts and helps. Adjusted EBITDA margin, they're expecting 20% for the full year, which if you noticed, starting here, it was 20% here, 21% here. So that essentially says they're going to maintain that 20% adjusted EBITDA margin for the rest of the year. And their two new loan verticals are looking really, really impressive. Upstart started auto lending a while ago, over 2 years ago, but it never really took off. Now it's really starting to go parabolic, and which is really significant because it's a much bigger market than personal loans. You can see sequentially this is up 87%. It's roughly 6x over the past year. Auto loans make up less than 5% of Upstart's total, so it's not getting too much attention yet, but it kind of should be, especially if this kind of traction continues. But the real story, in my opinion, is the home loan originations, specifically home equity lines of credit. That's what Upstart's originating, and that's the newest vertical. That just started a little bit right before 2024, and you can see that that's up 9x year over year and 67% sequentially. This is a huge market. Americans have $35 trillion in home equity. I did a whole other video on it you can watch. And it's a massive opportunity, especially as rates come down. If Upstart's doing this in a terrible lending environment right now, the average home equity line of credit interest rate is in the 8 to 9% range. It's significantly higher than the average mortgage rate. So if they're doing this in an environment where people are paying that to borrow against their equity, imagine what they could do if rates drop to 5%, 6%. So big opportunity here. But as I mentioned, the stock went down after earnings, and with all I've said so far, you might be wondering why. So there are two big, I don't want to say red flags, but things to watch that I noticed. The loan conversion funnel. This is the percentage of people who request a rate on Upstart's platform that end up getting a loan. Now, a year ago, Upstart was being pretty conservative with lending. It definitely ticked upward, but now all of a sudden in the second quarter, it shot up from about 19% to almost 24%. This begs the question, is Upstart relaxing its lending standards in order to maintain a great growth rate? I don't know that it is. There might be some really good explanations. Maybe some of its partners have more appetite for loans. I don't know what it is, but that definitely is something to keep an eye on, or at least, do a little more digging on. So that's one potential red flag that I'm seeing. And, another metric they put in their presentation that I didn't include in the slideshow really kind of illustrates that the percentage of loans that are in what they consider their super prime credit category as a percentage of their total loan volume declined by about 2 percentage points from the first quarter to the second. So, they might have a little bit of lower credit quality coming in the door, so that could be a risk factor. And not only that, the loans that they're holding on their balance sheet are increasing. Upstart holds some loans on its balance sheet. A lot of the time, they have them because they're just holding them until they can sell them to third parties, or just for a little while until they can get them out the door to other lenders or whatever it may be. But this green bar up here are what are called the R&D loans. Those are loans that Upstart is holding on its balance sheet to test its credit methodology before it really opens them up to partners. And right now that consists of those two new verticals, auto loans and home loans. But that's a pretty big quarterly increase. They went from holding $538 million of loans on their balance sheet in this R&D category to $700 million, roughly a 30% jump in one quarter. Now, holding loans on their own balance sheet, it's different than selling them to third-party lenders or originating them for third-party lenders, because Upstart is bearing the credit risk of these. So now they have $1 billion of loans on their balance sheet that they're bearing the credit risk on. I don't think it's as big of a risk factor as the market seems to make it out to be, but it definitely is a risk factor that's worth noting. So that's really the kind of rundown of Upstart's numbers. I do think that the stock is not worth or should not have taken quite as much of a hit. I'm holding it in my own portfolio. I'd love to hear what you think. Leave me any comments you might have under this video. I'll do my best to answer each of them individually, and thanks for watching. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.